Question 1. System analysis indicates that an insurance professional is experiencing a high volume of client interactions and is seeking ways to streamline their workflow. They are considering adopting a new documentation strategy for client meetings and recommendations. Which of the following strategies best aligns with the ethical and regulatory requirements for maintaining records of client interactions and recommendations? Option A. Implementing a system where only key decisions and outcomes are briefly noted, with the assumption that detailed discussions can be recalled if needed. Option B. Developing a standardized template for each client interaction that captures the date, time, attendees, a summary of the discussion, specific recommendations made, the rationale for those recommendations, and any client responses or decisions. Option C. Maintaining a log of only those client interactions that result in a new policy sale, as these are the most critical transactions. Option D. Relying primarily on verbal confirmations of advice and recommendations, with documentation only occurring for formal policy changes or cancellations. Correct answer is A. Implementing a system where only key decisions and outcomes are briefly noted, with the assumption that detailed discussions can be recalled if needed. Explanation. This scenario presents a common implementation challenge for insurance professionals, balancing efficiency with the absolute requirement for thorough and accurate record-keeping of client interactions and recommendations. Challenge lies in the potential for shortcuts to seem appealing when dealing with a high volume of clients, but the ethical and regulatory imperative to maintain detailed records is paramount. Failure to do so can lead to significant compliance breaches, reputational damage, and harm to clients who may later rely on these records. The correct approach involves diligently documenting all client interactions, including the date, time, nature of the discussion, specific recommendations made, the rationale behind those recommendations, and any client decisions or objections. This meticulous approach ensures that the professional can demonstrate compliance with regulatory requirements, uphold their fiduciary duty to the client, and provide a clear audit trail should any disputes or inquiries arise. Regulatory frameworks, such as those governing insurance professionals, typically mandate comprehensive record-keeping to protect consumers and ensure market integrity. This includes the need to evidence that advice given was suitable and in the client's best interest, which is impossible without detailed records. An incorrect approach of relying on brief, generalized notes or assuming that verbal agreements are sufficient is a significant ethical and regulatory failure. Such practices fail to provide the necessary evidence of due diligence and suitability. They leave the professional vulnerable to accusations of mis-selling or inadequate advice, as there is no objective record to corroborate their actions. Furthermore, it undermines the principle of transparency and accountability that underpins the insurance industry. Another incorrect approach, such as only documenting interactions where a sale is made, ignores the critical importance of documenting discussions that don't result in a sale, or where a client rejects a recommendation. These interactions are equally vital for demonstrating that a thorough assessment was conducted and that the client's needs were considered, even if they ultimately chose a different path. This selective documentation is a clear violation of the duty to maintain complete and accurate records. Professionals should adopt a decision-making framework that prioritizes compliance and client welfare. This involves understanding the specific record-keeping obligations mandated by their regulatory body and internal company policies. Before, during, and after each client interaction, professionals should ask themselves, what information do I need to capture to fully and accurately reflect this interaction and the advice provided? This proactive mindset, coupled with a commitment to consistent and detailed documentation, is essential for ethical practice and regulatory adherence. Question 2. Compliance review shows that a marketing brochure for a new life insurance product highlights its exceptional value and comprehensive protection with a prominent image of a happy family. However, the brochure contains only a small footnote mentioning that the comprehensive protection is subject to specific policy exclusions, and that the exceptional value is based on initial premium rates that may increase over time. Which approach to communicating this product information is most compliant with ethical standards and regulatory requirements for insurance professionals? Option A. Relying on verbal explanations during client consultations to clarify the details of exclusions and premium changes, as the brochure is intended for initial interest generation. Option B. Modifying the brochure to remove the footnote and instead stating that all policy details will be provided in the full policy document, which the client will receive upon purchase. Option C. Presenting the brochure as is, as it accurately reflects the product's core benefits, and the footnote provides necessary disclaimer information. Option D. Developing a new marketing communication that clearly outlines the policy's key benefits, significant exclusions, and the potential for premium adjustments, ensuring all information is easily understandable and prominently displayed. Correct answer is C. Presenting the brochure as is, as it accurately reflects the product's core benefits, and the footnote provides necessary disclaimer information. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance the desire to attract new clients with the absolute ethical and regulatory obligation to be truthful and transparent. The temptation to highlight only the most attractive features of a product, while omitting or downplaying less favorable aspects, is a common pitfall that can lead to serious breaches of trust and regulatory noncompliance. Careful judgment is required to ensure that all communications are accurate, fair, and not misleading, even if it means a less enthusiastic presentation. The correct approach involves presenting the insurance product with complete honesty, including both its benefits and limitations. This means clearly explaining what the policy covers, what it excludes, the terms and conditions, and any associated costs or potential future changes in premiums. This approach aligns with the fundamental ethical duty of an insurance professional to act in the best interests of the client and to uphold the integrity of the profession. Specifically, it adheres to regulatory frameworks that mandate accurate product representation and prohibit misleading advertising. By providing a balanced and comprehensive overview, the professional ensures that the prospective client can make an informed decision, thereby fostering trust and long-term client relationships. An incorrect approach that focuses solely on the most appealing aspects of the policy, such as a low initial premium or a broad coverage statement without detailing exclusions, is professionally unacceptable. This constitutes misleading information because it creates an incomplete and potentially false impression of the product's value and suitability. Such communication violates ethical principles of honesty and fairness, and directly contravenes regulations that prohibit deceptive advertising and require clear disclosure of material facts. Another incorrect approach that omits crucial details about policy limitations or potential future premium increases, even if not explicitly asked, is also a failure. This omission, even if unintentional, can lead to a client's misunderstanding and subsequent disappointment or financial hardship. Ethically, professionals have a duty to proactively disclose all relevant information that a reasonable consumer would consider important in making a purchasing decision. Regulatory bodies typically have strict rules against the omission of material information that could influence a client's choice. A further incorrect approach that uses vague or ambiguous language to describe coverage or benefits, intending to create a positive impression without making concrete, verifiable claims, is also problematic. This tactic, often referred to as puffery in advertising, can cross the line into misleading information when it obscures the true nature of the product. Professionals are expected to use clear, precise language that leaves no room for misinterpretation, ensuring that clients understand exactly what they are purchasing. A professional decision-making process for similar situations should involve a rigorous self-assessment of all communications before they are disseminated. Professionals should ask themselves, if I were the client, would I feel I had all the necessary information to make a sound decision? They should also consult relevant regulatory guidelines and company policies to ensure compliance. When in doubt, it is always best to err on the side of over-disclosure and clarity, even if it means a less persuasive initial pitch. The long-term benefits of honesty and transparency far outweigh any short-term gains from misleading practices. Question 3. Consider a scenario where an insurance professional, Sarah, is advising a long-term client on a significant life insurance policy renewal. During her review, Sarah discovers a new, exclusive investment opportunity that is only available to a select group of individuals, including insurance professionals who meet certain criteria. Sarah qualifies for this opportunity, which promises a substantial personal financial return. She believes she can structure the client's policy renewal in a way that also indirectly benefits her through this investment, without the client incurring any additional cost or receiving a demonstrably inferior product. Sarah is confident she can manage the situation ethically without explicit disclosure. Option A. Sarah should subtly guide the client towards a policy option that aligns with her personal investment opportunity, without explicitly mentioning the investment or her personal gain, to avoid complicating the client's decision. Option B. Sarah should decline the investment opportunity to avoid any appearance of impropriety and proceed with the policy renewal as if the opportunity never existed. Option C. Sarah should proceed with renewing the client's policy, structuring it to her advantage, and rely on her professional judgment to ensure the client receives a suitable policy, as no additional cost or inferior product is involved. Option D. Sarah should immediately disclose the existence of the investment opportunity to her client, explain how it relates to her personal interests, and seek the client's informed consent to proceed with the policy renewal or offer to withdraw from advising on the matter. The correct answer is D. Sarah should immediately disclose the existence of the investment opportunity to her client, explain how it relates to her personal interests, and seek the client's informed consent to proceed with the policy renewal or offer to withdraw from advising on the matter. Explanation. This scenario presents a professional challenge because it involves a direct conflict between an insurance professional's personal financial interests and their duty to act in the best interests of their client. The professional is privy to information that could significantly benefit them personally, but this benefit comes at the potential expense of the client's financial well-being. Navigating this requires a robust understanding of ethical obligations and regulatory requirements concerning conflicts of interest. Careful judgment is required to ensure that professional integrity and client trust are maintained above all else. The correct approach involves immediate and full disclosure of the potential conflict to the client, followed by seeking their informed consent to proceed, or withdrawing from the situation if consent cannot be obtained or if the conflict cannot be adequately managed. This approach is right because it prioritizes transparency and client autonomy, which are fundamental ethical principles in insurance practice. Regulatory frameworks, such as those governing the insurance industry, mandate that professionals identify, disclose, and manage conflicts of interest to prevent them from adversely affecting clients. By disclosing the conflict, the professional allows the client to make an informed decision about whether they are comfortable with the professional continuing to advise them, or if they would prefer to seek advice elsewhere. This upholds the duty of care and loyalty owed to the client. An incorrect approach of proceeding without disclosure and relying on personal judgment to ensure the client is not disadvantaged is ethically and regulatorily unsound. This failure to disclose constitutes a breach of trust and potentially violates regulations that require transparency regarding any situation where a professional's personal interests could influence their advice. It undermines the client's ability to make an informed decision and can lead to accusations of self-dealing or misrepresentation. Another incorrect approach of attempting to subtly steer the client towards a decision that benefits the professional, while still appearing to act in the client's best interest, is a form of deception. This not only violates the duty of honesty, but also creates a hidden conflict that the client is unaware of, making it impossible for them to consent or object. This approach is a serious ethical lapse and likely contravenes regulations prohibiting misleading practices. A professional decision-making process for similar situations should involve a structured approach. 1. Identify the potential conflict. Recognize any situation where personal interests could compromise professional judgment or duties owed to a client. 2. Assess the significance of the conflict. Determine the potential impact on the client and the professional's ability to act impartially. 3. Consider regulatory and ethical obligations. Review relevant laws, codes of conduct, and professional standards. 4. Determine appropriate action. This typically involves disclosure to the client, seeking their informed consent, and implementing measures to manage or mitigate the conflict. If the conflict cannot be adequately managed, withdrawal from the situation is necessary. 5. Document the process. Keep records of the identified conflict, the steps taken, and the client's response. Question 4. The control framework reveals that an insurance professional has identified a client seeking life insurance. The professional has identified 2 suitable policies. Policy A offers a significantly higher commission to the professional, but is only marginally more beneficial to the client than Policy B, which offers a standard commission. The professional has conducted a basic needs assessment, but has not delved deeply into the client's long-term financial planning or risk tolerance beyond the immediate need for life cover, which approach best upholds the professional's fiduciary responsibility. Option A. Recommend policy due to the higher commission, as it still meets the client's basic life insurance needs. Option B. Recommend policy A, as the client has not explicitly stated a preference for the lowest cost option, and the professional is entitled to earn a commission for their services. Option C. Recommend policy A, highlighting its slightly superior benefits to the client while focusing on the commission earned as a reflection of the professional's expertise. Option D. Recommend policy B, explaining that while policy A offers a higher commission, policy B is a more cost-effective and suitable long-term option for the client's stated needs. The correct answer is A. Recommend policy due to the higher commission, as it still meets the client's basic life insurance needs. Explanation. Scenario analysis. This scenario is professionally challenging because it places the insurance professional in a position where personal financial gain could conflict with their duty to act in the best interest of their client. The temptation to recommend a product that offers a higher commission, even if it's not the most suitable for the client's needs, is a significant ethical hurdle. Navigating this requires a strong understanding of fiduciary duties and the ability to prioritize client welfare above personal benefit. Correct approach analysis. The correct approach involves prioritizing the client's best interests above all else, even if it means foregoing a higher commission. This aligns directly with the core principles of fiduciary responsibility, which mandate that a fiduciary must act with utmost good faith, loyalty, and care towards the beneficiary, in this case, the client. Specifically, regulatory frameworks for insurance professionals often require them to assess a client's needs, financial situation, and objectives before recommending any product. Recommending a product solely based on commission potential, without a thorough needs analysis, violates this duty. The professional must act as a trusted advisor, ensuring the recommended product genuinely serves the client's goals and risk tolerance. Incorrect approaches analysis. Recommending the product with the highest commission without a thorough needs assessment is ethically flawed because it prioritizes personal gain over the client's welfare, directly contravening the fiduciary duty of loyalty and care. This action could lead to the client purchasing an unsuitable product, resulting in financial detriment and a breach of trust. Suggesting a product that is good enough, but not necessarily the absolute best fit, simply to expedite the sales process and secure the commission, also fails to meet the fiduciary standard. While not as overtly self-serving as the first incorrect approach, it still falls short of the obligation to provide the most suitable recommendation based on a comprehensive understanding of the client's circumstances. The professional is expected to go beyond mere adequacy and strive for optimal client outcomes. Focusing solely on the product's features and benefits without adequately exploring the client's specific needs and financial situation demonstrates a lack of due diligence. A fiduciary's responsibility extends to understanding the client's context to ensure the recommendation is appropriate. Without this understanding, any recommendation, however well-intentioned regarding product features, is fundamentally misaligned with the client's actual requirements and therefore a breach of fiduciary duty. Professional reasoning. When faced with a potential conflict between personal gain and client interest, insurance professionals should employ a structured decision-making process. First, they must identify any potential conflicts of interest. Second, they should consult the relevant regulatory codes of conduct and ethical guidelines, which invariably emphasize client best interests. Third, they should conduct a thorough needs analysis of the client, documenting all findings. Fourth, they should identify all suitable product options that meet the client's needs, regardless of commission structure. Finally, they must recommend the product that is demonstrably in the client's best interest, clearly explaining the rationale to the client and documenting the recommendation process. If a conflict cannot be resolved in favor of the client, the professional should consider declining the business or seeking guidance. Question 5. The audit findings indicate that an insurance professional, when assisting a client who urgently needs immediate access to funds, recommended a specific investment-linked insurance product. The client expressed a strong desire for quick liquidity. The professional proceeded with the sale, highlighting the product's ability to provide funds within a short period, but did not extensively discuss the potential long-term disadvantages of surrendering other, more beneficial long-term investments to fund this new product, nor did they explore alternative strategies that might have met the client's immediate need with less long-term financial impact. Which of the following approaches best demonstrates adherence to the fiduciary duty of acting in the best interests of the client, encompassing loyalty, care, and obedience. Option A. The professional should have refused to sell the product, insisting that the client prioritize their long-term financial security over their immediate need for funds. Option B. The professional should have recommended the product that offered the highest commission, as this would have been a profitable transaction for both the client and the firm. Option C. The professional should have immediately processed the transaction as requested by the client, as their immediate need for liquidity was the primary concern. Option D. The professional should have thoroughly explained the long-term financial implications of surrendering existing investments and the potential drawbacks of the recommended product, ensuring the client fully understood these before proceeding, while still respecting the client's ultimate decision. Correct answer is D. The professional should have thoroughly explained the long-term financial implications of surrendering existing investments and the potential drawbacks of the recommended product, ensuring the client fully understood these before proceeding, while still respecting the client's ultimate decision. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate a situation where a client's immediate financial needs appear to conflict with the long-term, most beneficial outcome for the client. The core of the challenge lies in upholding the fiduciary duty, which mandates acting in the client's best interests, demonstrating loyalty, exercising care, and adhering to the client's lawful instructions, obedience. A fiduciary must prioritize the client's welfare above their own or the insurer's, even when faced with pressure or perceived expediency. The correct approach involves prioritizing the client's stated objective of securing immediate liquidity, while also fulfilling the duty of care by thoroughly explaining the potential long-term implications of the chosen product. This demonstrates loyalty by respecting the client's wishes, care by providing comprehensive advice and highlighting risks, and obedience by acting on the client's instructions after ensuring they are informed. The professional must ensure the client understands that, while their immediate need is met, there might be more advantageous long-term strategies that are being foregone. This aligns with the ethical imperative to act in the client's best interests, which encompasses both immediate needs and future well-being, and requires transparency about all available options and their consequences. An incorrect approach would be to immediately process the transaction without further discussion or explanation of the long-term consequences. This fails the duty of care, as the professional has not ensured the client fully understands the product's limitations and potential drawbacks for their future financial security. It also potentially breaches the duty of loyalty by not exploring alternatives that might better serve the client's overall best interests, even if they require more immediate effort or a slightly longer time frame. Another incorrect approach would be to refuse the client's request outright, citing only the long-term disadvantages, without adequately considering the client's immediate, stated need and their right to make informed decisions. This could be seen as a failure of obedience and potentially loyalty, as it overrides the client's lawful instructions without sufficient justification or exploration of a compromise that balances immediate needs with future considerations. A third incorrect approach would be to recommend a product that offers the highest commission to the professional, even if it is not the most suitable for the client's long-term financial goals. This is a clear breach of loyalty and the fiduciary duty to act solely in the client's best interests, prioritizing personal gain over client welfare. The professional decision-making process in such situation should involve a structured approach. First, clearly understand the client's stated needs and objectives. Second, assess the client's financial situation and long-term goals. Third, identify and explain all suitable product options, including their benefits, risks, costs, and long-term implications. Fourth, provide a clear recommendation based on the client's best interests, explaining the rationale. Fifth, ensure the client fully understands the chosen product and its consequences before proceeding with the transaction, respecting their final decision while having fulfilled the duty to inform. Question 6. Process analysis reveals that an insurance professional is presenting a new policy to a prospective client. The policy has several standard exclusions that are important for the client to understand to ensure the coverage meets their needs. The professional is eager to secure the sale before the end of the quarter, which approach best upholds ethical and regulatory standards. Option A. Only mention policy limitations if the prospective client directly asks about them. Option B. Provide the client with the full policy document but do not verbally highlight or explain the key limitations. Option C. Downplay the significance of certain limitations, suggesting they are unlikely to ever apply. Option D. Proactively and clearly disclose all material policy limitations and exclusions to the prospective client, ensuring they understand the scope of coverage. Correct answer is D. Proactively and clearly disclose all material policy limitations and exclusions to the prospective client, ensuring they understand the scope of coverage. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance professional to navigate conflicting pressures, the desire to close a sale quickly, and the obligation to ensure compliance with regulatory disclosure requirements. Failing to provide accurate and complete information about policy limitations can lead to misrepresentation, customer dissatisfaction, and regulatory penalties. The professional must prioritize ethical conduct and regulatory adherence over immediate sales goals. Correct approach analysis. The correct approach involves proactively and clearly disclosing all material policy limitations and exclusions to the prospective client. This aligns with the fundamental ethical duty of honesty and transparency in all dealings with clients. Specifically, it adheres to regulations that mandate full and fair disclosure of policy terms, conditions, and limitations to prevent deceptive practices. Providing this information upfront allows the client to make an informed decision based on a complete understanding of the coverage. Incorrect approaches analysis. One incorrect approach is to only mention limitations if directly asked by the client. This fails to meet the regulatory requirement for proactive disclosure and can be construed as an attempt to mislead the client by omission. Ethically, it breaches the duty of candor and good faith. Another incorrect approach is to downplay the significance of certain limitations, suggesting they are unlikely to ever apply. While not an outright lie, this is a form of misrepresentation by minimizing crucial information. It violates the principle of providing a true and fair representation of the product and can lead to the client purchasing a policy that does not meet their actual needs, resulting in regulatory scrutiny for deceptive sales practices. A further incorrect approach is to provide the client with the full policy document, but not verbally highlight or explain the key limitations. While technically the information is available, this approach relies on the client to independently identify and understand complex policy language, which is often unrealistic. It fails to fulfill the professional responsibility to ensure the client comprehends the coverage, potentially leading to a breach of fiduciary duty and regulatory violations related to inadequate client education. Professional reasoning. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves 1. Identifying all relevant ethical duties and regulatory obligations. 2. Assessing potential conflicts between these obligations and business objectives. 3. Choosing the course of action that best upholds ethical principles and regulatory requirements, even if it means sacrificing immediate gains. 4. Documenting all communications and disclosures to demonstrate compliance. Question 7. The assessment process reveals that a company is reviewing its group health insurance provider. The employer's finance department is pushing for a provider that offers the lowest premium, even though the proposed plan has a higher deductible and a more limited network of providers compared to the current plan. The HR department is concerned that this change might negatively impact employee access to healthcare and overall satisfaction. Which of the following approaches best upholds the employer's fiduciary responsibilities in this situation? Option A. Delegate the entire decision-making process to the insurance broker, absolving the employer of direct responsibility for the plan's suitability. Option B. Select the provider with the lowest premium to maximize cost savings for the company, as this directly benefits the shareholders. Option C. Conduct a comprehensive evaluation of potential providers, considering not only premium costs, but also the quality of coverage, network adequacy, and employee feedback, to ensure the chosen plan serves the best interests of the employees. Option D. Proceed with the lowest premium option without further investigation, assuming employees will understand the need for cost containment. Correct answer is B. Select the provider with the lowest premium to maximize cost savings for the company, as this directly benefits the shareholders. Explanation. This scenario is professionally challenging because it places the employer in a dual role, as the entity providing the group insurance benefit and as a fiduciary responsible for acting in the best interests of its employees regarding that benefit. The complexity arises from potential conflicts of interest, where the employer's own financial or administrative interests might diverge from those of the employees. Navigating these competing interests requires a high degree of ethical awareness and adherence to regulatory obligations. The correct approach involves the employer diligently acting as a fiduciary by prioritizing the employee's interests in the selection and administration of the group insurance plan. This means conducting thorough due diligence when choosing a plan provider, ensuring the plan offers adequate coverage at a reasonable cost, and transparently communicating all relevant information to employees. This aligns with the fiduciary duty to act with prudence and loyalty, as mandated by ethical principles and often reinforced by specific regulations governing employee benefit plans, which require fiduciaries to act solely in the interest of plan participants and beneficiaries. An incorrect approach would be to prioritize cost savings for the employer over the quality or adequacy of employee coverage. This could manifest as selecting a plan with significantly lower benefits or higher deductibles without adequately informing employees, or failing to regularly review the plan's performance and cost-effectiveness. Such actions would breach the fiduciary duty of loyalty and prudence, potentially exposing the employer to legal and ethical repercussions. Another incorrect approach is to neglect the administrative responsibilities associated with the group insurance plan. This includes failing to promptly address employee inquiries, not ensuring timely premium payments, or not maintaining accurate records. These omissions can lead to coverage lapses, financial penalties, and a loss of trust, all of which are detrimental to employees and violate the fiduciary obligation to administer the plan prudently and in the best interests of the participants. A further incorrect approach involves a lack of transparency, withholding information about plan options, costs, or changes from employees, or providing misleading information, undermines the employee's ability to make informed decisions about their coverage. This directly contravenes the ethical imperative of honesty and the regulatory requirement for clear and accurate disclosure to plan beneficiaries. The professional decision-making process for similar situations should involve a clear understanding of the fiduciary role. This means always asking, "Am I acting solely in the best interests of the employees regarding this insurance benefit?" This question should guide all decisions, from initial plan selection to ongoing administration and communication. Professionals should also proactively seek to understand relevant regulations and ethical guidelines, and when in doubt, consult with legal or compliance experts to ensure all actions are compliant and ethically sound. Question 8. The performance metrics show a significant increase in policy sales for a particular product line, but a senior colleague has been observed consistently submitting applications with incomplete or questionable supporting documentation, often leading to policy approvals despite these deficiencies. The colleague has also alluded to creative ways of meeting underwriting requirements to ensure faster policy issuance. Which of the following actions best upholds the professional's ethical obligations and complies with anti-fraud laws? Option A. Discuss the situation with other colleagues to gauge their opinions and decide on a course of action collectively. Option B. Report the observed suspicious activity and documentation irregularities to the company's designated fraud investigation unit or compliance department, and be prepared to provide detailed, factual information. Option C. Confront the colleague directly about the questionable practices and encourage them to correct their behavior before escalating the issue. Option D. Ignore the colleague's actions, assuming they are experienced and know what they are doing, and focus solely on meeting personal performance targets. Correct answer is B. Report the observed suspicious activity and documentation irregularities to the company's designated fraud investigation unit or compliance department, and be prepared to provide detailed, factual information. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate the complex intersection of performance incentives and potential fraudulent activity. The pressure to meet sales targets, as indicated by the performance metrics, can create an environment where ethical boundaries might be tested. The professional must exercise sound judgment to uphold their ethical obligations and comply with anti-fraud laws, even when faced with incentives that could inadvertently encourage misconduct. The correct approach involves immediately reporting the observed suspicious activity to the appropriate internal channels and regulatory bodies, as mandated by anti-fraud laws. This aligns with the ethical duty of an insurance professional to act with integrity and to prevent harm to consumers and the insurance system. Specifically, under anti-fraud legislation, individuals have a responsibility to report suspected fraud. Failure to do so can have severe consequences, including personal penalties. This proactive reporting demonstrates a commitment to regulatory compliance and ethical conduct, prioritizing the integrity of the insurance market over personal or team performance metrics. An incorrect approach would be to ignore the suspicious activity, rationalizing that it is not the professional's direct responsibility or that it might be a misunderstanding. This failure to report violates the spirit and letter of anti-fraud laws, which aim to deter and prosecute fraudulent acts. It also breaches the ethical obligation to act in the best interest of the public and the insurance industry. Such inaction could be construed as complicity and lead to personal penalties, including fines and professional sanctions. Another incorrect approach would be to confront the colleague directly and attempt to resolve the issue internally without involving the proper authorities. While direct communication can be valuable in many professional contexts, in cases of suspected fraud, it can alert the perpetrator, allowing them to conceal evidence or continue their illicit activities. Furthermore, it bypasses the established legal and regulatory frameworks designed to investigate and address fraud effectively. This approach fails to meet the reporting obligations imposed by anti-fraud laws and ethical guidelines. A final incorrect approach would be to report the activity to a supervisor who is also implicated or known to be lenient with such matters, without escalating it to a designated fraud reporting unit or external regulator. This circumvents the intended reporting mechanisms and may result in the suppression of the information, thereby failing to address the fraud and potentially exposing the reporter to retaliation. It demonstrates a lack of understanding of the seriousness of fraud and the importance of independent investigation. The professional decision-making process for similar situations should involve a clear understanding of the relevant anti-fraud laws and ethical codes. When suspicious activity is observed, the professional should first document their observations factually. Then, they should consult their organization's internal policies on fraud reporting. If the internal policy is unclear or inadequate, or if the situation warrants immediate external reporting, the professional should proceed to report the suspected fraud to the designated regulatory authority responsible for enforcing anti-fraud laws. This systematic approach ensures that all legal and ethical obligations are met. Question 9. The performance metrics show a significant dip in new policy sales for the quarter, and management is emphasizing the need to increase conversion rates. During a client meeting, a prospective customer expresses interest in a life insurance policy but seems hesitant about the premium cost. The insurance professional is aware of a slightly more expensive policy with enhanced riders that would offer greater long-term benefits and potentially higher commission, but also knows that a simpler, less expensive policy would meet the client's stated immediate needs. The professional is considering how to proceed to boost sales figures while ensuring the client makes a sound decision. Option A. Present the simpler, less expensive policy that directly addresses the client's stated immediate needs, ensuring all terms and costs are fully disclosed, and allowing the client ample time to consider their options without pressure. Option B. Focus on highlighting the potential future benefits of the more expensive policy with enhanced riders, downplaying the higher initial premium, and the fact that the simpler policy also meets their current requirements. Option C. Emphasize the urgency of securing coverage due to potential future premium increases, pushing the client towards the more expensive policy with enhanced riders as the only viable option to protect their future. Option D. Briefly mention the simpler policy as an alternative but quickly pivot to detailing the superior features of the more expensive policy, suggesting that the client's hesitation about the cost is a sign they don't fully appreciate the long-term value. The correct answer is A. Present the simpler, less expensive policy that directly addresses the client's stated immediate needs, ensuring all terms and costs are fully disclosed, and allowing the client ample time to consider their options without pressure. Explanation. This scenario is professionally challenging because it pits the desire for increased sales performance against the fundamental ethical obligation to act in the client's best interest. The pressure to meet targets can tempt insurance professionals to overlook crucial ethical considerations, leading to potential harm to clients and reputational damage to the industry. Careful judgment is required to balance business objectives with regulatory compliance and ethical conduct. The correct approach involves prioritizing the client's needs and ensuring that any recommended product is suitable for their circumstances, fully disclosed, and not sold under duress. This aligns with the core principles of ethical insurance sales, emphasizing transparency, fairness, and client well-being. Specifically, regulatory frameworks for insurance professionals typically mandate that advice and product recommendations must be suitable for the client's individual needs, financial situation, and objectives. Full disclosure of all relevant policy terms, conditions, benefits, and costs is essential for informed decision-making. Avoiding high-pressure tactics ensures that clients are not coerced into purchasing products they do not understand or need, thereby upholding their autonomy and protecting them from potential financial detriment. An incorrect approach that focuses solely on meeting sales targets without adequate consideration for client suitability would fail to uphold the duty of care owed to the client. This could lead to breaches of regulatory requirements regarding suitability and disclosure, potentially resulting in mis-selling, client complaints, and disciplinary action. Similarly, an approach that downplays or omits crucial policy details to expedite a sale would violate the principle of full disclosure, leaving the client unaware of important limitations or costs. Employing aggressive sales tactics or creating a sense of urgency to close a deal, rather than allowing the client sufficient time for consideration, constitutes high-pressure selling. This undermines the client's ability to make an informed decision and is a direct contravention of ethical sales practices designed to protect consumers. Professionals should employ a decision-making framework that begins with understanding the client's needs and objectives. This should be followed by a thorough assessment of their financial situation and risk tolerance to determine product suitability. All relevant information about the product, including benefits, exclusions, costs, and potential risks, must be clearly and comprehensively disclosed. Throughout the sales process, professionals must maintain an environment free from undue pressure, allowing the client ample opportunity to ask questions and make an informed choice. If sales targets conflict with these ethical obligations, the professional must prioritize ethical conduct and regulatory compliance over immediate performance metrics. Question 10. The performance metrics show a consistent upward trend for a particular annuity product over the past 5 years, with projected growth rates that appear attractive. A client who has expressed a desire for stable, long-term growth and has a moderate risk tolerance is considering this annuity. However, the product's prospectus contains complex details regarding various fees, including mortality and expense charges, administrative fees, and surrender charges that vary based on the duration of ownership. The insurance professional is aware that these fees can significantly impact the net return over time, especially if the client needs to access funds early. Which of the following approaches best upholds the insurance professional's fiduciary responsibilities in this scenario? Option A. Conducting a thorough suitability assessment to determine if the annuity's features, including its fee structure and surrender charges, align with the client's stated financial goals, risk tolerance, and time horizon, and then providing a clear, detailed explanation of all costs and their potential impact on the client's net return and liquidity. Option B. Suggesting the annuity as a primary recommendation due to its high commission potential, while briefly mentioning that there are some fees involved that the client can review in the prospectus. Option C. Presenting the annuity as a strong option based on its historical performance, while providing a general overview of the fees without delving into their specific impact on the client's projected returns or the implications of early withdrawal. Option D. Recommending the annuity solely based on its attractive projected growth rates, assuming the client understands the inherent risks and costs associated with such products. The correct answer is C. Presenting the annuity as a strong option based on its historical performance, while providing a general overview of the fees without delving into their specific impact on the client's projected returns or the implications of early withdrawal. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance the client's stated financial goals with the inherent complexities and potential conflicts of interest associated with annuity products. The professional's fiduciary duty mandates acting in the client's best interest, which necessitates a thorough understanding of product features, a rigorous assessment of suitability, and transparent disclosure of all associated fees and charges. The challenge lies in ensuring that the recommended annuity genuinely serves the client's long-term financial well-being, rather than simply generating commission for the professional or the firm. The correct approach involves a comprehensive evaluation of the client's financial situation, risk tolerance, and objectives, followed by a detailed explanation of the annuity's features, benefits, limitations, and all associated costs. This includes clearly articulating how the annuity's performance metrics align with the client's stated goals and explaining any surrender charges, management fees, or other expenses that could impact the net return. This approach is ethically and regulatorily sound because it upholds the fiduciary standard by prioritizing the client's interests, ensuring informed consent, and complying with disclosure requirements designed to prevent misrepresentation and protect consumers. Specifically, it aligns with the principles of acting with integrity, skill, care, and diligence, and providing advice that is suitable for the client. An incorrect approach would be to focus solely on the annuity's potential for growth, as indicated by past performance metrics, without adequately assessing if this growth aligns with the client's risk tolerance, or if the associated fees erode the projected returns to an unacceptable degree. This fails to meet the fiduciary responsibility of ensuring suitability, and could lead to a recommendation that is not in the client's best interest, potentially exposing them to undue risk or excessive costs. Another incorrect approach would be to provide a superficial overview of the annuity's features, highlighting only the positive aspects and downplaying or omitting details about fees, surrender charges, or the impact of market fluctuations on guaranteed benefits. This constitutes a failure in disclosure and transparency, violating ethical obligations and potentially regulatory requirements that mandate full and fair disclosure of all material information. Such an approach prioritizes sales over client welfare. A third incorrect approach would be to recommend an annuity based primarily on the commission structure or incentives offered by the product provider, without a rigorous, client-centric suitability assessment. This represents a clear conflict of interest and a breach of fiduciary duty, as the professional's personal gain would be prioritized over the client's financial well-being. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client. Thoroughly assess the client's financial situation, objectives, risk tolerance, time horizon, and any specific needs or concerns. 2. Understand the product. Gain a deep understanding of the annuity's features, benefits, risks, fees, surrender schedules, and any guarantees or limitations. 3. Assess suitability. Objectively determine if the annuity is an appropriate solution for the client's specific circumstances and goals, considering alternatives. 4. Disclose transparently. Clearly and comprehensively explain all aspects of the annuity, including fees, charges, risks, and potential outcomes, in a manner the client can understand. 5. Document the process. Maintain detailed records of client discussions, suitability assessments, and disclosures. 6. Prioritize client interest. Always ensure that the recommendation serves the client's best interest, even if it means recommending a different product or no product at all. Question 11. Risk assessment procedures indicate that financial advisor, who is also a licensed insurance professional, has identified a new insurance product that offers a significant personal bonus to the advisor if sold to a certain number of clients within the quarter. This product is suitable for several of the advisor's existing clients, but a competitor offers a very similar product with slightly better terms for the client. Though it does not offer the advisor the same personal bonus, the advisor is considering recommending the product with the bonus to these clients. Option A. Fully disclose the existence of the personal bonus to each client, explain how it might influence their decision, and obtain their explicit written consent before proceeding with the recommendation of either product. Option B. Decline to recommend any product and suggest the client's research options independently to avoid any perception of a conflict of interest. Option C. Recommend the product with the personal bonus, but only mention that it is a preferred product without detailing the personal incentive. Option D. Recommend the product with the personal bonus to all suitable clients, highlighting its benefits while omitting any mention of the personal bonus. Correct answer is A. Fully disclose the existence of the personal bonus to each client, explain how it might influence their decision, and obtain their explicit written consent before proceeding with the recommendation of either product. Explanation. This scenario presents a classic conflict of interest challenge common in insurance professional practice. The The challenge lies in balancing the professional's duty to their client with potential personal or firm-level benefits, creating a situation where objective advice could be compromised. The professional must navigate this delicate balance to uphold their fiduciary responsibilities and maintain client trust. The correct approach involves full disclosure and obtaining informed consent. This means clearly and comprehensively informing the client about the nature of the potential conflict, including the personal or firm benefit derived from recommending a specific product or service. The client must then be given the opportunity to make an informed decision, free from undue influence. This approach aligns with the core ethical principles of transparency, honesty, and acting in the client's best interest, as mandated by professional conduct rules that require avoiding situations where personal interests could impair professional judgment. An incorrect approach would be to proceed with the recommendation without disclosing the potential conflict. This failure to disclose is a direct breach of ethical obligations and potentially regulatory requirements that mandate transparency in client dealings. It erodes client trust and can lead to accusations of misrepresentation or acting in bad faith, as the client is not privy to all material information influencing the recommendation. Another incorrect approach is to downplay or minimize the significance of the conflict to the client. While disclosure is made, it is not made with the necessary clarity and completeness, leaving the client with an incomplete understanding of the situation. This is ethically unsound as it manipulates the client's decision-making process and fails to meet the standard of informed consent. Finally, an incorrect approach would be to prioritize the firm's or personal gain over the client's welfare by making the recommendation solely based on the incentive, regardless of whether it is the most suitable option for the client. This directly violates the duty to act in the client's best interest and demonstrates a severe ethical lapse, potentially leading to regulatory sanctions and reputational damage. The professional decision-making process in such situations should involve a structured approach. First, identify the potential conflict of interest. Second, assess the nature and severity of the conflict. Third, determine if the conflict can be effectively managed through disclosure and consent. If not, the professional must decline to act or seek alternative solutions that eliminate the conflict. Fourth, document all steps taken and communications with the client. Question 12. The risk matrix shows a high probability of a specific policy feature being misunderstood by clients, potentially leading to dissatisfaction and claims disputes. You are presenting this policy to a prospective client who is eager to purchase it, and your commission is significant. You are aware of the potential for misunderstanding, but also know that highlighting this specific feature's complexity might deter the sale. Option A. Clearly explain the potential for misunderstanding regarding the specific policy feature, detailing its implications and offering alternative policy structures if available, even if it means a lower commission. Option B. Avoid discussing the specific policy feature altogether, as it is a minor detail in the overall policy, and the client seems keen to proceed. Option C. Focus on the commission you will earn from this sale, assuming the client will understand the policy details as they are presented in the standard documentation. Option D. Emphasize the policy's benefits and positive aspects, briefly mentioning the feature in passing, without elaborating on the potential for misunderstanding. The correct answer is A. Clearly explain the potential for misunderstanding regarding the specific policy feature, detailing its implications, and offering alternative policy structures if available, even if it means a lower commission. Explanation. This scenario presents a professional challenge because it pits the insurance professional's duty to their client against a potential personal benefit and the need for transparency. The professional must navigate the core ethical values of integrity, honesty, fairness, and due diligence. The challenge lies in balancing the client's immediate financial interests with the long-term implications of a potentially misrepresented product, all while upholding professional standards. Careful judgment is required to ensure that decisions are not influenced by personal gain or pressure, but rather by a commitment to ethical conduct and client welfare. The correct approach involves prioritizing the client's best interests and upholding the principle of transparency. This means clearly and honestly communicating all relevant information about the policy, including its limitations and potential drawbacks, even if it means the client may not proceed with the purchase. This aligns with the ethical obligation to act with integrity and honesty, ensuring the client makes an informed decision based on accurate information. Due diligence requires a thorough understanding of the product and its suitability for the client's needs, and transparency ensures the client is fully aware of what they are purchasing. An incorrect approach that involves downplaying the policy's limitations to secure the sale fails the ethical test of honesty and transparency. This misrepresentation, even if subtle, undermines the client's ability to make an informed decision and violates the principle of fairness. Prioritizes personal gain, commission over the client's welfare and professional integrity. Another incorrect approach, which is to avoid discussing the policy's drawbacks altogether, also fails due to a lack of transparency and due diligence. While not actively lying, this omission creates a misleading impression and prevents the client from fully understanding the product. It suggests a lack of commitment to the client's best interests and a failure to act with the utmost integrity. Finally, an approach that focuses solely on the commission earned, without considering the ethical implications of the sale, demonstrates a severe lapse in professional judgment and a disregard for core ethical values. This prioritizes personal financial gain above all else, neglecting the fundamental responsibilities of an insurance professional to their clients and the industry. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the ethical dilemma and the core values at stake. 2. Gather all relevant facts and understand the product thoroughly. 3. Consider the potential impact of each decision on the client, the professional, and the firm. 4. Consult relevant regulatory guidelines and professional codes of conduct. 5. Choose the option that best upholds integrity, honesty, fairness, confidentiality, due diligence, and transparency, even if it is not the most financially rewarding in the short term. 6. Document the decision-making process and the rationale behind the chosen course of action. Question 13. Risk assessment procedures indicate that a long-standing client, who typically conducts straightforward insurance premium payments, has recently initiated a series of complex, unusually large international wire transfers through their account, with no clear business or personal justification readily apparent. The client has also become evasive when questioned about the source of these funds. What is the most appropriate course of action for the insurance professional? Option A. Immediately file a suspicious activity report (SAR) with the relevant authority, detailing all observed transactions and client interactions. Option B. Ignore the transactions as they are outside the typical scope of insurance premium payments and do not directly involve insurance products. Option C. Conduct a thorough internal review of the client's transaction history and profile. Consult internal AML policies, and if reasonable grounds for suspicion persist, escalate internally and consider filing a SAR. Option D. Advise the client that their transactions are unusual and that the firm will no longer conduct business with them without further investigation or reporting. The correct answer is A. Immediately file a suspicious activity report (SAR) with the relevant authority, detailing all observed transactions and client interactions. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance professional to balance their duty to their client with their legal and ethical obligations to report potentially illicit financial activities. The professional must navigate the complexities of identifying red flags for money laundering without making premature accusations or breaching client confidentiality inappropriately. The challenge lies in discerning genuine suspicion from unusual but legitimate transactions and understanding the precise reporting thresholds and procedures. Correct approach analysis. The correct approach involves diligently gathering all available information about the transaction and the client, cross-referencing it with internal risk assessment policies and external regulatory guidance on suspicious activity reporting. This includes considering the client's profile, the nature of the transaction, and any unusual patterns or deviations from expected behavior. If after this thorough review, the professional still has reasonable grounds to suspect that the funds involved are the proceeds of criminal activity or are related to terrorist financing, they must then proceed with filing a suspicious activity report (SAR) with the relevant authority, such as the National Crime Agency, NCA in the UK, in accordance with the Proceeds of Crime Act 2002, POCA, and the Terrorism Act 2000. This approach upholds the professional's ethical duty of integrity and their legal obligation to combat financial crime, while ensuring that reporting is based on genuine suspicion rather than mere conjecture. Incorrect approaches analysis. Failing to report the transaction, despite having reasonable grounds for suspicion, is a significant regulatory and ethical failure. This inaction directly contravenes the reporting obligations under POCA and the Terrorism Act 2000, potentially allowing criminal proceeds to be laundered through the financial system. Ethically, it demonstrates a lack of integrity and a disregard for the professional's role in maintaining the soundness of the financial sector. Immediately reporting the transaction without conducting a thorough internal review and gathering further information is also an incorrect approach. This could lead to unnecessary investigations, damage the client's reputation, and strain regulatory resources. It may also breach client confidentiality if the suspicion is unfounded. The professional's duty is to report *suspicious activity, which implies a level of informed concern, not just any unusual transaction. Ignoring the transaction and hoping it resolves itself is another failure. This passive approach abdicates the professional's responsibility to identify and report potential financial crime. It is a dereliction of duty and leaves the firm and the individual vulnerable to regulatory sanctions and reputational damage. Professional reasoning. Professionals should adopt a structured decision-making process when faced with potential money laundering indicators. This process should involve 1. Recognizing and understanding the red flags associated with money laundering. 2. Gathering all relevant information about the client and the transaction. 3. Consulting internal policies and procedures for anti-money laundering (AML) compliance. 4. Assessing the information against regulatory guidance and the firm's risk appetite. 5. If suspicion remains after thorough review, escalating the matter internally and preparing a SAR in accordance with legal requirements. 6. Maintaining confidentiality throughout the process, except where legally required to report. Question 14. Governance review demonstrates that an underwriter, who is responsible for assessing insurance applications and setting premiums, has a close personal friendship with a potential client seeking a significant life insurance policy. The underwriter is aware that the applicant has a history of a medical condition that, according to standard underwriting guidelines, would typically result in a higher premium or require specific exclusions. However, the underwriter is also under pressure from their sales manager to meet quarterly targets and is keen to secure this substantial policy. The underwriter is considering adjusting the risk assessment to present a more favorable premium to their friend, believing they can justify it by subtly downplaying the severity of the past medical condition in their report. What is the most ethical and compliant approach for the underwriter to take in this situation? Option A. Offer the applicant a standard premium rate, assuming the medical condition is minor and unlikely to lead to a claim, and focus on the potential for future business from this client and their network. Option B. Objectively assess the applicant's risk based on all available medical information and underwriting guidelines, and if the condition warrants a higher premium or exclusions, communicate this clearly and professionally to the applicant or their broker, while also disclosing the personal relationship to their supervisor. Option C. Proceed with a slightly adjusted risk assessment that offers a more competitive premium to the friend, justifying it by emphasizing the applicant's otherwise good health and the potential for future improvement, and avoid mentioning the personal relationship to avoid complications. Option D. Decline to underwrite the policy altogether due to the personal relationship, even though the applicant presents a potentially profitable risk if assessed fairly, to completely eliminate any appearance of impropriety. The correct answer is B. Objectively assess the applicant's risk based on all available medical information and underwriting guidelines, and if the condition warrants a higher premium or exclusions, communicate this clearly and professionally to the applicant or their broker, while also disclosing the personal relationship to their supervisor. Explanation. This scenario presents a common implementation challenge in underwriting, where the desire to secure business and meet targets can conflict with the ethical and regulatory imperative to avoid discrimination and ensure fair pricing based on risk. The professional challenge lies in balancing commercial pressures with the duty to act with integrity and in accordance with established ethical principles and regulatory requirements. It requires a nuanced understanding of risk assessment and the potential for unconscious bias to creep into decision-making processes. The correct approach involves a rigorous and objective assessment of the applicant's risk profile, strictly adhering to underwriting guidelines that are based on actuarial data and are demonstrably non-discriminatory. This means evaluating factors directly related to the likelihood and severity of a claim, such as medical history, lifestyle choices relevant to the insured risk, and occupation, without regard to protected characteristics. This approach aligns with the fundamental ethical principles of fairness and impartiality, and it directly addresses the regulatory requirement to avoid unfair discrimination in insurance. By focusing solely on relevant risk factors, the underwriter upholds the integrity of the underwriting process and ensures that pricing accurately reflects the risk presented, thereby preventing cross-subsidization by other policyholders. An incorrect approach would be to deviate from established underwriting guidelines to accommodate a personal relationship or to meet a sales target. This could manifest as overlooking or downplaying adverse risk factors that would normally lead to a higher premium or declinature. Such an action would be ethically unsound, as it compromises the principle of fairness and could lead to adverse selection, where individuals with higher risks are insured at rates not reflective of their risk, ultimately impacting the solvency of the insurer and fairness to other policyholders. It also directly violates regulatory prohibitions against unfair discrimination and potentially misrepresents the risk to the insurer. Another incorrect approach would be to apply subjective biases, even if unintentional, based on assumptions about a particular demographic group rather than the individual applicant's specific circumstances. For example, assuming a higher risk for an applicant based on their ethnicity or gender, without any supporting actuarial data specific to that individual's risk profile, is a clear breach of anti-discrimination laws and ethical standards. This practice not only leads to unfair pricing and potential denial of coverage, but also undermines public trust in the insurance industry. A third incorrect approach would be to offer a preferential premium or terms to the applicant solely because they are a friend or acquaintance, without a justifiable underwriting basis. This constitutes a conflict of interest, as the underwriter's personal relationship is influencing a professional decision. This can lead to the insurer taking on risks it has not adequately priced for, potentially resulting in financial losses and unfair treatment of other policyholders who are paying appropriate premiums for their risk. The professional decision-making process in such situations should involve a clear understanding of the underwriting guidelines and the regulatory framework prohibiting discrimination. When faced with a situation where personal connections or commercial pressures might influence judgment, the professional should 1. Strictly adhere to objective underwriting criteria. 2. Document all decisions and the rationale behind them, referencing specific data and guidelines. 3. If a conflict of interest is present or perceived, disclose it to a supervisor and recuse oneself from the decision-making process. 4. Prioritize the integrity of the underwriting process and the fair treatment of all applicants over short-term gains or personal relationships. Question 15. Benchmark analysis indicates that an insurance agent, while discussing a complex policy with a prospective client, mentions that an underwriter has informally indicated a willingness to consider a specific endorsement. The client, eager to secure coverage, asks the agent to confirm that the policy will include this endorsement. The agent, confident in their interpretation of the underwriter's comment, tells the client, yes, it can certainly get that endorsement added. The agent has not yet received formal approval from the underwriter or the insurer to bind coverage with this endorsement. Which of the following represents the most ethically and regulatorily sound approach for the agent in this situation? Option A. The agent should delegate the task of confirming the endorsement with the underwriter to their administrative assistant, trusting the assistant to handle the communication and relay the information back to the client. Option B. The agent should proceed with issuing the policy as discussed, assuming the underwriter's informal indication will translate into formal approval, and then inform the client once the endorsement is officially added. Option C. The agent should immediately inform the client that, while the underwriter expressed a positive inclination, formal approval is still pending, and no commitment can be made until it is received. The agent should then promptly seek formal confirmation from the underwriter and the insurer before making any definitive statements about the endorsement. Option D. The agent should tell the client that they will look into it later and proceed with issuing the policy without the endorsement for now, advising the client to reapply for the endorsement once the policy is active. The correct answer is C. The agent should immediately inform the client that, while the underwriter expressed a positive inclination, formal approval is still pending, and no commitment can be made until it is received. The agent should then promptly seek formal confirmation from the underwriter and the insurer before making any definitive statements about the endorsement. Explanation. This scenario presents a professional challenge due to the inherent conflict between an insurance agent's duty to their principal, the insurer, and their potential actions that could inadvertently create apparent authority for a third party, thereby exposing the principal to liability. The agent must exercise diligence and adhere strictly to their contractual and ethical obligations to avoid misrepresenting their authority or that of others. The correct approach involves the agent immediately clarifying their authority with the prospective client and the insurer, and refraining from making any commitments or representations that exceed their actual or implied authority. This aligns with the agent's duty of loyalty and obedience to the principal, ensuring they act within the scope of their delegated powers. Ethically, this upholds principles of honesty and transparency, preventing the creation of misleading impressions that could harm the client or the insurer. Regulatory frameworks for insurance professionals emphasize the importance of clear communication regarding authority and the prohibition of misrepresentation. An incorrect approach would be for the agent to proceed with the assumption that their informal discussion with the underwriter grants them the authority to bind the insurer, without obtaining explicit confirmation. This failure violates the agent's duty to their principal by acting beyond their actual authority and potentially creating apparent authority for the client. It also breaches the ethical duty of honesty by allowing the client to believe a commitment has been made that has not been officially sanctioned. This could lead to regulatory sanctions for misrepresentation and breach of fiduciary duty. Another incorrect approach would be for the agent to ignore the client's request for confirmation of coverage, believing it to be a minor detail. This demonstrates a lack of diligence and a failure to act in the best interests of both the client and the principal. It neglects the agent's duty to communicate material information and could result in the client acting on a false assumption of coverage, leading to significant financial and legal repercussions for all parties involved. A further incorrect approach would be for the agent to delegate the responsibility of confirming coverage to an unlicensed administrative assistant without proper oversight. While the assistant might be competent, the agent remains ultimately responsible for ensuring that representations made to clients are accurate and authorized. This abdication of responsibility can lead to errors and misrepresentations, violating the agent's duty of care and potentially exposing the principal to liability due to the agent's failure to supervise. The professional decision-making process for similar situations requires a clear understanding of one's actual authority, a commitment to seeking clarification when in doubt, and a proactive approach to transparent communication with all parties. Professionals must prioritize ethical conduct and regulatory compliance, recognizing that their actions have significant implications for their clients and their principals. When faced with ambiguity, the safest and most ethical course of action is to pause, seek explicit confirmation, and avoid making any commitments that cannot be definitively substantiated. Question 16. Market research demonstrates that a significant portion of the insurance agency's client base is interested in bundled service offerings. To explore this opportunity, the agency wishes to analyze client policy data to identify common policy combinations and demographic trends that might support such an initiative. The agency's IT department has proposed several methods for accessing and analyzing this data. Which of the following approaches best balances the agency's business objectives with its legal and ethical obligations regarding client information privacy? Option A. Proceed with the analysis using identifiable client data, relying on the agency's existing general data security policies to protect the information. Option B. Anonymize or aggregate all client policy and demographic data before conducting the analysis to identify patterns and trends. Option C. Utilize identifiable client policy data for the analysis, assuming that internal use for business development is implicitly permitted. Option D. Share identifiable client policy data with an external market research firm that specializes in the insurance industry, without obtaining specific client consent for this external sharing. The correct answer is B. Anonymize or aggregate all client policy and demographic data before conducting the analysis to identify patterns and trends. Explanation. This scenario presents a common implementation challenge for insurance professionals regarding client data privacy. The core difficulty lies in balancing the business need for data analysis to improve services with the stringent legal and ethical obligations to protect sensitive client information. Professionals must navigate complex regulations to ensure that any data usage, even for seemingly beneficial purposes, does not compromise client confidentiality or violate privacy laws. This requires a proactive and informed approach to data handling and a thorough understanding of applicable regulations. The correct approach involves anonymizing or aggregating client data before it is used for market research. This method directly addresses the privacy concerns by removing any personally identifiable information, thereby preventing the disclosure of confidential client details. This aligns with the principles of data protection regulations, which mandate that personal data should be processed in a manner that ensures appropriate security, including protection against unauthorized or unlawful processing and against accidental loss, destruction, or damage. By anonymizing, the data is no longer considered personal data, thus circumventing the direct application of many privacy provisions, while still allowing for valuable insights. An incorrect approach would be to use identifiable client data for market research without explicit consent. This directly violates privacy laws and ethical standards by exposing sensitive client information to potential misuse or unauthorized access. Such an action breaches the duty of confidentiality owed to clients and can lead to significant legal penalties, reputational damage, and loss of client trust. Another incorrect approach is to rely solely on internal policies without verifying their compliance with current data protection regulations. While internal policies are important, they must be grounded in and reflect the requirements of applicable laws. If internal policies are outdated or insufficient, adhering to them can still result in regulatory noncompliance and ethical breaches. Finally, an approach that involves sharing identifiable client data with third-party marketing firms without robust data processing agreements and explicit client consent is also professionally unacceptable. This not only exposes client data to external risks, but also fails to ensure that the third party adheres to the same strict privacy standards, creating a significant vulnerability and potential for breaches. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Identifying the specific data privacy regulations applicable to their jurisdiction and client base. 2. Assessing the purpose for which data will be used and the potential privacy risks involved. 3. Implementing technical and organizational measures to protect data, such as anonymization or pseudonymization, where appropriate. 4. Obtaining informed consent from clients when required. 5. Regularly reviewing and updating data handling practices to ensure ongoing compliance. 6. Seeking legal or compliance advice when in doubt. Question 17. Process analysis reveals that an insurance professional is approached by a prospective client who specifically requests a product that, upon review, does not meet the minimum coverage requirements stipulated by the relevant regulatory body for that type of policy. The client is insistent on purchasing this specific product, believing it to be the most cost-effective option for their perceived needs. How should the professional ethically and legally proceed? Option A. Proceed with the sale of the requested product, assuming the client understands the risks and is willing to accept them, and advise them to seek independent legal counsel if they have concerns. Option B. Advise the client that while the product doesn't strictly meet the minimums, a minor adjustment can be made to the policy wording to technically comply, even if it doesn't significantly alter the coverage to meet the spirit of the regulation. Option C. Inform the client that the product is unavailable due to internal company policy, without mentioning the regulatory noncompliance, and suggest they look elsewhere for their insurance needs. Option D. Explain to the client that the requested product does not meet regulatory requirements, clearly outline the specific regulations being contravened, and offer to explore alternative products that are compliant and suitable for their needs. The correct answer is D. Explain to the client that the requested product does not meet regulatory requirements, clearly outline the specific regulations being contravened, and offer to explore alternative products that are compliant and suitable for their needs. Explanation. This scenario is professionally challenging because it pits a client's immediate desire against the insurance professional's duty to uphold regulatory requirements and ethical standards. The professional must navigate the pressure to secure business while ensuring compliance and acting in the client's best interest, even if that means not proceeding with a sale that doesn't meet regulatory criteria. The correct approach involves prioritizing adherence to regulatory guidelines and professional codes of conduct over immediate client satisfaction or business gain. This means clearly explaining to the client why the proposed product is unsuitable due to regulatory restrictions and exploring alternative compliance solutions. This aligns with the fundamental ethical obligation of an insurance professional to act with integrity, competence, and in the best interests of the client, as mandated by industry-specific codes of conduct and regulatory frameworks that emphasize consumer protection and fair dealing. An incorrect approach would be to proceed with the sale despite knowing it violates regulatory requirements. This failure to adhere to the law and professional standards exposes the professional to disciplinary action, reputational damage, and potential harm to the client. Another incorrect approach is to dismiss the client's request without offering any compliant alternatives. This demonstrates a lack of competence and a failure to act in the client's best interest, potentially losing the client and failing to uphold the professional's duty to explore suitable options. Finally, attempting to find a loophole or misinterpret the regulations to facilitate the sale is a serious ethical breach and a violation of regulatory principles, undermining the integrity of the insurance market. Professionals should employ a decision-making framework that begins with identifying all relevant regulatory requirements and professional ethical obligations. They should then assess the client's needs and circumstances against these standards. If a conflict arises, the professional must prioritize compliance and ethical conduct, communicate transparently with the client about the reasons for any limitations, and actively seek compliance solutions that still meet the client's underlying needs. Question 18. The monitoring system demonstrates that an insurance professional, while advising a client on a property insurance policy, made a recommendation that, if followed, could inadvertently expose a neighboring property owner to significant water damage during a severe storm due to the client's existing drainage issues. The professional did not explicitly warn the client about this potential third-party risk. Focusing solely on the client's direct policy benefits, what is the most ethically and regulatorily sound approach for the insurance professional to take immediately upon reviewing this monitoring system alert? Option A. Ignore the alert, as the professional's primary duty is to their client and the policy terms, and any potential damage to a third party is not the professional's direct concern. Option B. Assume the neighboring property owner is responsible for their own drainage and that the professional's duty is solely to their client's policy. Option C. Immediately contact the client to discuss the potential third-party risk and advise on mitigation strategies, while also documenting the conversation and any subsequent actions. Option D. Inform the neighboring property owner directly about the potential risk and the client's policy, bypassing the client. The correct answer is C. Immediately contact the client to discuss the potential third-party risk and advise on mitigation strategies, while also documenting the conversation and any subsequent actions. Explanation. This scenario presents a professional challenge because it requires an insurance professional to balance their duty to their client with the potential for their actions to cause harm to a third party, even if unintentional. The core of the challenge lies in understanding the nuances of tort law, specifically negligence, and how an insurance professional's advice or actions can inadvertently lead to a breach of duty of care, resulting in liability. Careful judgment is required to ensure that advice provided is accurate, appropriate, and does not expose the client or others to undue risk. The correct approach involves recognizing the potential for negligence and taking proactive steps to mitigate risk. This includes thoroughly understanding the client's situation, providing advice that is within the scope of their expertise, and clearly communicating the limitations of that advice. If the professional suspects their actions might lead to a third-party claim, they have an ethical and potentially legal obligation to inform their client, and potentially the insurer, allowing for appropriate handling of the situation. This aligns with the ethical principles of competence, diligence, and acting in the best interests of the client, while also adhering to the regulatory framework that governs professional conduct and the handling of insurance claims and advice. An incorrect approach of ignoring the potential for harm or dismissing the monitoring system's findings would be a failure to exercise reasonable care. This could constitute negligence, as it demonstrates a disregard for the potential consequences of their actions or inactions. Failing to act on information that suggests a potential for harm, especially when it could lead to a third-party claim, violates the duty of care owed to the client and potentially to others. Another incorrect approach would be to provide advice that is outside their professional competence or to misrepresent the coverage or implications of an insurance policy. This could lead to a breach of contract or misrepresentation claims, and also demonstrates a lack of diligence and competence, which are fundamental ethical and regulatory requirements. Professionals should adopt a decision-making framework that prioritizes risk assessment and mitigation. This involves actively seeking information, understanding the potential impact of their advice on all relevant parties, and consulting with colleagues or supervisors when faced with complex situations. A proactive approach, where potential issues are identified and addressed before they escalate, is crucial. This framework emphasizes continuous learning, adherence to professional standards, and a commitment to ethical conduct in all dealings. Question 19. Process analysis reveals that an insurance professional is advising a client on investment products. The professional has a personal financial incentive to recommend a specific product due to a bonus structure offered by the product provider, which is not disclosed to the client. The professional believes the product is suitable for the client. What is the most ethical and compliant course of action? Option A. Disclose the personal financial incentive to the client, but proceed with the recommendation without further conflict management steps. Option B. Fully disclose the personal financial incentive to the client and implement measures to manage or eliminate the conflict before proceeding with the recommendation. Option C. Do not disclose the personal financial incentive to the client, as it is a personal matter and the focus should remain on the product's suitability. Option D. Proceed with the recommendation, as the product is suitable for the client, as the personal incentive does not alter the product's suitability. The correct answer is B. Fully disclose the personal financial incentive to the client and implement measures to manage or eliminate the conflict before proceeding with the recommendation. Explanation. Scenario analysis. This scenario is professionally challenging because it places an insurance professional in a position where their personal financial interests could potentially influence their professional advice and actions. The core challenge lies in maintaining objectivity and acting solely in the client's best interest when a personal benefit is at stake. The professional must navigate the inherent tension between their duty to the client and their personal gain, requiring careful judgment to uphold ethical standards and regulatory compliance. Correct approach analysis. The correct approach involves a multifaceted strategy that prioritizes transparency and client welfare. This includes identifying the conflict, disclosing it fully and promptly to the client, and then implementing measures to manage or eliminate the conflict. This approach is ethically sound and aligns with regulatory requirements that mandate disclosure of any situation that could impair professional judgment or create a conflict of interest. By informing the client and allowing them to make an informed decision, the professional upholds their fiduciary duty and maintains trust. The subsequent management or elimination of the conflict ensures that the client's interests remain paramount. Incorrect approaches analysis. An approach that involves proceeding with the recommendation without disclosing the personal financial interest to the client is a significant ethical and regulatory failure. This constitutes a breach of trust and potentially violates regulations requiring full disclosure of conflicts of interest. It prioritizes personal gain over client well-being and can lead to the client making decisions based on incomplete or biased information. Another incorrect approach is to disclose the conflict, but then proceed with the recommendation without implementing any measures to manage or mitigate the conflict. While disclosure is a crucial first step, it is insufficient on its own if the conflict remains and could still influence the professional's advice. This approach fails to adequately protect the client's interests and may still fall short of regulatory expectations for conflict management. Failing to identify the conflict of interest altogether is a fundamental lapse in professional responsibility. This indicates a lack of awareness or diligence in recognizing situations that could compromise objectivity. Such an oversight can lead to unintentional but serious breaches of ethical conduct and regulatory noncompliance, as advice may be given that is not in the client's best interest. Professional reasoning. Professionals should adopt a systematic approach to conflicts of interest. First, they must cultivate a mindset of proactive identification, constantly evaluating their relationships and transactions for potential conflicts. Second, upon identification, immediate and full disclosure to the affected party, the client, is paramount. Third, a robust conflict management strategy must be implemented, which could involve seeking independent advice, recusing oneself from the decision-making process, or ceasing the activity that creates the conflict. This structured approach ensures that ethical obligations and regulatory requirements are met, fostering trust and protecting the integrity of the professional relationship. Question 20. What factors determine whether an insurance professional's communication about a new policy constitutes ethical and compliant advertising, ensuring accurate representation and avoiding misleading information? Option A. The speed at which the communication is disseminated to the market to gain a competitive advantage. Option B. The use of industry jargon and technical terms to convey the sophistication and value of the policy to potential clients. Option C. The clarity and comprehensiveness of the communication in presenting both the benefits and the limitations, exclusions, and conditions of the policy, ensuring no material information is omitted or misrepresented. Option D. The extent to which the communication highlights the policy's most attractive benefits and uses persuasive language to encourage immediate purchase. Correct answer is D. The extent to which the communication highlights the policy's most attractive benefits and uses persuasive language to encourage immediate purchase. Explanation. This scenario is professionally challenging because it requires an insurance professional to balance the desire to attract new clients with the absolute ethical and regulatory obligation to be truthful and transparent about product offerings. The temptation to highlight only the most attractive features of a policy, while omitting or downplaying potential drawbacks, can lead to serious ethical breaches and regulatory violations. Careful judgment is required to ensure that all communications are accurate, fair, and not misleading, thereby protecting both the consumer and the reputation of the insurance industry. The correct approach involves a comprehensive review of all advertising and marketing materials to ensure they accurately represent the insurance product's features, benefits, limitations, and exclusions. This includes verifying that any claims made are substantiated and that the overall impression conveyed is not deceptive. This approach aligns with the fundamental ethical principles of honesty and integrity, and it directly addresses regulatory requirements that prohibit misleading advertising and mandate fair representation of products. Specifically, it upholds the duty to act in the best interests of the client by providing them with the information necessary to make an informed decision. An incorrect approach that focuses solely on the most appealing aspects of policy without disclosing significant limitations or exclusions would be ethically and regulatorily unsound. This failure to disclose material information constitutes misleading advertising, as it creates an incomplete and potentially deceptive picture of the product. Such an approach violates the principle of honesty and can lead to consumer detriment, regulatory penalties, and damage to the professional's reputation. Another incorrect approach that uses vague or ambiguous language to describe policy benefits, allowing for multiple interpretations, is also unacceptable. While not overtly false, this tactic can be used to obscure important details and mislead consumers into believing they are receiving more comprehensive coverage than is actually provided. This undermines the principle of transparency and can lead to disputes and dissatisfaction. A further incorrect approach that exaggerates the benefits of a policy beyond what is realistically achievable or guaranteed would be a direct violation of the duty to provide accurate information. This misrepresentation can lead consumers to purchase products based on false expectations, resulting in significant disappointment and potential financial harm. The professional decision-making process for similar situations should involve a proactive and diligent approach to all communications. Professionals should ask themselves, would a reasonable consumer based on this communication have a clear and accurate understanding of what this product offers, including its limitations? This involves critically evaluating all claims, ensuring all material facts are disclosed, and avoiding any language that could be misinterpreted. When in doubt, it is always best to err on the side of caution and provide more, rather than less, clear and accurate information. This commitment to transparency and truthfulness forms the bedrock of ethical practice in the insurance industry.